got that G, got my nullos. I'm just saying. You pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light.
I got chills, then multiply.
So hello everyone, it's Harvey and I'm back for another video, and I hope you guys are having a good tomorrow. Welcome to my channel. How are you guys doing, guys? I have a new series and it's all about options trading on Webull. I thought about it, I was like, oh my god, this would be a great idea. So let's get into it. So I hope you guys, before watching this video, you have an idea of what you're doing, but if you don't, that's okay. But I want to say this, in order for you to watch this video, that means you're interested in looking for another form of income or another way of making revenue, and I found options trading other than just having my stocks and investments, and I would like to share what I've learned with you guys, okay? So what is option trading? I'll be screen recording my phone so that way we can learn this together, okay? But so let's get into what option trading is all about, okay? First, I will show you guys the dictionary meaning of options, okay? It says the term option refers to a financial instrument that is based on the value of underlying securities, also known as stocks. So when they say securities, it's just saying stocks, okay? An option contract offers the buyer the opportunity to buy or sell. You will hear a lot about this in options, depending on the type of contract they hold, the underlying asset, which is stock, okay? Now, unlike futures, is that the holder is not required to buy or sell the asset if they decide against it. So it's another form of being able to own an asset or a stock without selling it or buying it. You may want to buy it, or you may want to sell it, or you may want to keep it. That's what it means. Now, each contract has an expiration date. Unlike stocks that don't have expiration dates, option contracts do have an expiration date, and they are typically sold and bought through online retail brokerage accounts or brokerage.
Yeah, girl. Oh my god. You know, clearly you need to relax. Well, don't. Woo! Just sit down. Now, come on. All right, Vent. Come on now. It couldn't have just kicked in like that.
Oh Lord, my pressure.
When did
each contract has an expiration date by which the holder must exercise the option of either selling it or buying it. Now, the three key takeaways is that options are financial derivatives that gives the buyer the right but not the obligation to buy or hold or sell an underlying asset at the agreed upon dates or price. What it's saying is that these stuffs has an expiration. They take that, they can buy the option or sell the option.
this ain't no allegedly.
Okay, another key option or key note you should take from this is that option trading has two types. We have call options and put options, okay? Although there are many opportunities to profit with options, investors should also know that there are risks. Let's be real. In life, there are no risk, no reward, right? So these are the take notes. Now let's get to the basics of option trading. I'll go to my Webull account and then let's get into the main. Okay, so this is my account. I've shown you guys before. With the stock market, it's been hell, so this is why my account looks like this. But this is the most important part where we want. It's called learning. Okay,
we're gonna get into some technicalities here because you know they always got to come with the receipt.
I'll go to learning there. Okay, now I have option basics. Now this will help me explain in details the best way. Okay, so option trading comes in two forms. We have calls and we have puts. The best way to describe this would be, I'm picking up the phone. You see, when I receive a call, what do? I'll pick up the phone like, hey, what are you doing, right? Now, puts, when someone calls me and the person is a mess, I would put down the phone. In other words, when I notice that a stock is going down, I would buy puts.
The orders are on their way.
By which time I shall be gone, and you shall be dead.
Puts is when the market is going down. Call is when the market is going up. That's when you go into calls. Does that make sense? Yeah, so picking up the phone, that's when the market is going up. You're picking up the phone, so you make calls, right? Now, putting down the phone, when you put down the phone because you don't want to deal with it, you know that the market is going down. We don't want our stocks to go down. See what? That's how I can describe calls and puts the easiest way. So now we have two option contracts, okay? Calls and puts. A call option, also known as a call option trading, gives the buyer the right to buy an underlying security, also known as the stock, right, at a particular amount of time, which means it has an expiration date. I am paraphrasing it because that's the best way. It obliges the call seller to sell the underlying securities at a particular price. That's a call option. So if I'm making a call, hey, if this stock goes up to $10 but I bought it at $6, for example, or I bought it at $13 but it has gone down to $10, right, or gone down to $6, I'm saying that this stock, if it goes back to $10 or $13, I am willing to sell. So call option, the option to sell up, okay? Some people can sell down, which should be stupid because you will lose a lot of money, right? We don't want that, okay?
The woman I'm trying to become would draw no satisfaction from this at all. Fortunately, I'm not that woman just yet.
Then a put option gives the buyer the right to sell a stock, also known as the underlying security, at a specified price. Now, most times when you're doing call options, put options, or option trading, you should have up to 100 shares of a particular stock in your portfolio. But if you don't have that, you can do what we call a naked call or a naked put. That's when you don't have the stock, which means you have to have the cash on the side just in case your contract goes through and you may have to sell or buy, okay? A put option gives the buyer the right to sell the underlying security at a specified price and obliges the put seller to buy the underlying security at that price. I would explain this. This is the basics. Now we have premium. Okay, premium, the cash price the option buyer pays to the option seller. So when I sell an option, in order for the person, it's like, okay, hey guys, I want to buy your stock at this price, okay? So I am giving you this in advance. A premium is also known as an advance payment for a stock. That's the best and easiest way to put it. It's an advance, so also known as a premium, an advance payment.
Y'all heard it, right?
Period.
I am saying that the cash price the option buyer pays the option seller. For example, an option contract that trades for $1 as a premium is worth 100, as each contract covers 100 shares. Like I said, you have to have up to 100 shares. I love this because premium, when you hear premium, some people are like, what the hell is that? Premium is also known as advance payment, okay? So if you are a new beginner, that's the easiest way to put it, just like I explained, picking up the call and putting down the phone. Calls and puts, okay? That is the two fundamentals of option trading. The third point would be the strike price. Now, the strike price, why I am a fan of the strike price is that when you go into a contract, it's like buying a house. You guys will agree on a strike price, right? Like, okay, so this is where we agree. You know, you the buyer, you're willing to pay this price, and I the seller, I'm willing to sell that contract at that price. So when we shake on it like sold, that is the strike price.
I'm back, I'm better.
So the strike price is the predetermined price at which the option contract becomes exercisable, which means that is where it goes through. When you put your card through, right, a credit card, if it doesn't go through, that means it has not been excisable or it has not been excised. So when it goes through, the payment goes through, then it has been cleared. You know, when your cash or your check clears or the contract is sold, you know, done, like the case close, that is exercisable. That's the easiest way to break down that word, exercisable, for someone that is like, what are all these terms? Then for calls, the underlying stock price exceeds this strike price. This strike price, that means when you do, like I said, if the stock was as, let's say, $4, you're like, okay, my strike price I'm willing to sell this stock would be at $10, and once it gets to $10, so the person can take the stock away from me. So any other additional growth on that stock, I would not benefit from it, but the person who bought it from me would benefit. So call, see, call up. Now for puts, the underlying stock price falls below. So when it falls below the strike price, done, see, it's going down. So once it falls below, that's why you're going against it. So the more the stock falls, the more money you would make as the one who bought the puts. But if the stock starts going up, guess what's gonna happen? You're fucked, because now the person who sold the puts will be the one making the money, because the person wants it out the money and you want it in the money, okay? So I love this. Now we have, which is the fourth option, in the money and out the money, which is ITM. You'll see a symbol ITM and OTM. In order to start stock trading, option trading, you must have registered to become an option trader. You cannot just trade, you have to do it in a brokerage, you have to register for it, okay? So now in the money means when the contract is worth exercising, okay, which is, it's in the money. Now a call is in the money when the stock, let's just so that way it's not, or the option or the contract exceeds the strike price. Okay, and a put is in the money when the stock price falls. See, you're betting against the money. So if your strike price is, for example, $5 for a put, and then the stock goes to $6, you who bought the put, you'll be losing money, and the person who sold the put will be making money. Okay, then that will be the reverse when it becomes a call. Okay, so you who sold the call, when it's in the money, the person is making I love this. Okay,
look at us, huh? Who would have thought? Not me.
So a put is in the money when the underlying stock falls below the price. So option buyers want the option contract to be in the money. At the money is when the option is outside, whereby the market price is equals the strike price, or when the market price is equals the strike price. So out the money, okay, we have in the money, at the money, and out the money. So what I just said is at the money when it's equality, right? Out the money now is when an option is outside of the comfort zone, when the money is not, when it's not worth exercising. So as a result of that, option sellers want the contracts to be out of the money. See, you're selling, so when it's out the money, the person who sold will be benefiting. Then we have expiration dates. All options, plain and simple, have expiration dates. Unlike having a stock that you bought with your money, when you buy a stock, that means you have part of the shares of that company. So that does not have an expiration except they go out of business, okay? But options, on the other hand, has an expiration, and American contracts or option contracts allows the buyer to exercise its rights at any time, before or at the day of expiration, but the timing is between 9:30 and 4 p.m. okay?
The stress, girl, the stress of my life. What are you talking about? I could pop it any time.
So you have to exercise it, because if you don't exercise it, when it gets to the end date, it becomes either worthless or Webull would exercise it out for you, okay?
Wait a minute, who am I? That's a Raven moment.
Then 6th point is that we have the break even. Now the break even point, whenever you buy puts or sell puts, or buy options or sell options, calls or sell calls, there is always what we call the break even point. So the break even point is the point at which the investor doesn't lose money or doesn't make money. So when you buy a call or buy a put and it doesn't move, it's 0.00. That means you ain't making no money. I'll show it to you in one of my puts or call that I got, so you can see what it looks like when it's break even. Okay, but let's put it this way: for calls, the break even is found by adding the strike price and the premium. For puts, the break even is found by the strike price minus the premium, because remember, when you sell puts, right? Remember, when you sell or buy puts, there is a point where they meet. Now, the lower it goes, you, the buyer of the put, makes money. The higher it goes, you, the buyer, makes no money. So when it gets to that break-even point, because remember, when you bought a put, you are paying money to say, okay, I would want to get those rights to sell that stock from you. But when you sell a put, you get a premium. Now, if the contract is not sizable and it goes worthless because it fell out of the money, it goes worthless, you have to keep that premium because you're safe. You see, so there is a win and a lose, or a lose and a win in this situation of trading options. That's why they say you can make rewards, you can make profits, and also you can lose money. Okay,
The is getting hot in this sweater dress. Let me turn on the fan real quick.
So one who buys a put or buys a call pays. One who sells a put or sells a call gets a premium. Okay, now the 7 point to know is that trading hours are from 9:30 a.m. to 4 p.m. from Mondays to Fridays. Okay, so these are the basics of option trading. I will show you guys what's a break-even put. I wanted to show you guys when you don't make money, right? So the break-even, let me show you guys what the break-even looks like. So this is a break-even. Let's go to my, okay. So I have this call. This is a call. So you can see that I have, click on short. So you can see that I have the market value is -15 and the total cost is -15. So at this point, I'm at a break even. I am neither making money or making a loss. So that's what a break even looks like. Okay, so I hope this little information helps someone out there that has been curious about stocks option trading. I wanted to give you guys like a breakdown first. Okay, this is the basics. I can't wait to see you guys soon in the next video, but this is a journey that I'm happy about, and I hope you guys too are happy about this. Until next time, from Salvador and DAWSON Studio, bye guys.